Hello and welcome to PPC Money Matters, a channel that covers everything regarding stocks and investing, personal finance, and opportunities as a self-employed in the finance industry. I'm your host, Finn. Today I'm going to talk about the collapse of First Republic Bank, one of the biggest bank failures in U.S. history. If you're new here, make sure to subscribe and hit the bell icon for more videos like this. First Republic Bank was a San Francisco-based bank that catered to wealthy clients who rarely defaulted on their loans. It had a $24 billion market cap and over 80 branches across the country. But in May 2023, it was seized by federal regulators and sold to JPMorgan Chase, leaving its creditors and shareholders with nothing. So what happened? How did First Republic go from being a successful bank to a bankrupt one in just a few months? Well, there are several factors that contributed to its downfall, but the main one was the rising interest rates. You see, First Republic was heavily reliant on borrowing money from other banks and investors to fund its loans. This worked well when interest rates were low, but when the Federal Reserve started raising rates in 2022 and 2023 to combat inflation, First Republic's interest expenses skyrocketed. According to its financial reports, its interest expenses increased by more than 2,000% year-over-year and 153% quarter-over-quarter in the last quarter of 2022. This squeezed its profit margins and made it harder to repay its debts. Another factor that hurt First Republic was the collapse of two other banks that served similar markets, Silicon Valley Bank and Signature Bank. Both of these banks failed in March 2023 due to their exposure to the volatile cryptocurrency industry and the tech sector. When these banks failed, they triggered a panic among customers and investors who feared that First Republic might be next. Many of them withdrew their deposits or sold their shares, causing a liquidity crisis for First Republic. In fact, the bank lost over $100 billion of customer deposits over the quarter. To make matters worse, the federal government did not guarantee deposits above the $250,000 limit set by the FDIC for First Republic, unlike what they did for Silicon Valley Bank and Signature Bank. This meant that many of First Republic's wealthy customers could lose a lot of money if the bank failed. Before we dive more into the intriguing story of the bank run triggered by the two banks, let's take a moment to appreciate our sponsor, DoneIT.SG. This reliable IT solutions company is dedicated to supporting company founders and self-employed professionals with straightforward and affordable IT solutions. The experts at DoneIT.SG take the time to understand your unique business operations, helping you find cost-effective solutions that can often be tailored using existing online services. This means you won't have to worry about overspending on custom-built systems that are costly to modify or maintain. The consultants at DoneIT.SG are committed to providing honest advice to clients in the early stages of their businesses, increasing the likelihood of success. They understand the importance of finding the right balance between functionality and affordability, making them the ideal partner for entrepreneurs and professionals on a budget. If you're looking for a dependable IT partner to help your business grow, consider DoneIT.SG. They're here to make a difference in your journey towards success. Now, let's get back to the First Republic Bank. In an attempt to save First Republic, a consortium of 11 major U.S. banks injected $30 billion into it in March 2023 with the backing of the government. But this was not enough to stop the bleeding. In April 2023, First Republic reported a 41% drop in deposits and a massive loss for the first quarter. By then, it was clear that First Republic was doomed. On May 1, 2023, federal regulators closed it down and sold its assets and operations to JPMorgan Chase for $10.6 billion in cash, with an additional $50 billion to be paid in 5 years. JPMorgan CEO Jamie Dimon said that this part of the crisis is over after the deal was announced. The deal also included a loss-sharing agreement between JPMorgan Chase and the FDIC, which aimed to minimize the risks to the banking system and protect taxpayers. Under this agreement, JPMorgan Chase would absorb the first $1 billion in losses, while the FDIC would cover 80% of the remaining losses up to a certain threshold. But for many people who had money or shares in First Republic, this was a devastating blow. They lost everything they had invested in the bank and had no recourse. Some of them were prominent figures in business, politics, and entertainment who had trusted First Republic with their finances. The collapse of First Republic also raised questions about the stability of the U.S. banking system and the role of the government in regulating it. Some critics argued that the government should have intervened sooner or more aggressively to prevent such a large bank from failing. Others said that the government should have let First Republic fail without any bailout or assistance, as a lesson for other banks to be more prudent. Additionally, the fallout from First Republic's collapse could have a lasting impact on mid-sized regional banks in the U.S., as they may face increased scrutiny and regulation, which could further impact their profitability and growth prospects. In conclusion, the story of First Republic Bank's collapse teaches us the importance of being cautious when making investment decisions. As investors, we should conduct thorough research and be aware of potential risks. It's essential for us to diversify our investments to avoid putting all our resources into one company or sector. We need to pay attention to economic factors like interest rates, regulations, and market changes. By staying informed and prepared, we can make better investment decisions and minimize our risks. That's all for today's video. Thank you for tuning in to Money Matters, a channel brought to you by Pinnacle Personnel Consultancy. PPC is a dynamic and innovative company. We're committed to providing exceptional networking events and fostering connections within the finance industry.